Welcome to this webinar with fxstreet.com. In this webinar today we're going to talk about a little scalping strategy that we use, and ultimately it's to profit from the flow of the FX markets, and I'll get more into it in a minute. But just before we do get started, a couple of the housekeeping items. So obviously the disclaimer, which say the content of this webinar is not investment advice in any way whatsoever, and it's used only for educational purposes, okay, because trading carries a high degree of risk. And ultimately what that means is that if you like what you see in this webinar, you still need to go away and make your own decisions as to whether it's right for you. Don't just go and trade it because I'm telling you to do it. It has to be your own decision, essentially. For those of you that don't know me, my name's Alex Ong. I'm the co-founder of TradersCorner-online.com. It's an educational website that my brother and I put together to help people such as yourselves try and get ahead in the FX markets and indeed any of the financial markets. We've been trading since around 2005, so what is that, nearly 8-9 years now. We've co-authored articles, my brother and I, for FX Street, and a number of other websites and magazines, and we've also developed some educational products as in video courses, books, etc., etc. What we're going to do in today's webinar is, as I said, we're going to talk about scalping and profiting from the flows in the FX markets. Now, I'm not going to do this via a presentation. I could give you rules and everything, but I thought it's probably better to show you what it actually looks like in real life and talk to you about it in real life, looking at real charts, because you probably get the most out of it that way. So let me just go and find my chart. I've got too many open here. Hold on. There we go. So if that's okay with you guys, we're not going to do it and give you slides upon slides upon slides. I'm going to talk to you about the system itself, looking at live markets. Sound like a plan? Don't be shy. Excellent. Okay, so when I'm talking about scalping the FX markets, what I'm looking to do, okay, so you're looking to extract small profits from the markets, but often. All right. Now, the thing with scalping in the way that we do it is that you have to be careful to make sure that you're trading in the right market conditions. So this isn't necessarily going to be a system or strategy that someone brand new to FX is going to get on with. And don't get me wrong, you may be able to make money, but the problem with this sort of trading is that you're taking a lot of opportunities a day, and if you don't have your money management right, and all of your risk management and all of that kind of good stuff, then you could kill yourself very, very quickly, okay? Because if you take a look here, this is yesterday, look at the amount of opportunities there were yesterday. Look at all of these swings that occurred yesterday. So for that reason, by the same token as you saw that we were making money all of yesterday, you could get into a choppy market. Let me try and find one. Well, I need one. Where is it? So you could end up getting into something like this. Now, even though you would have made money for these opportunities as well, there is a possibility that as a new trader, if you don't have control of your emotions, you make a mistake, you take a loss, you make another mistake, you take a loss, you try and rectify that mistake, you compound the loss, and it just gets very, very messy. All right. So the idea of this particular strategy is you need to wait for the right market conditions. All right. Now, the other thing with this strategy, as I said, we're profiting from the flows in the FX market. Now, what that means is that I'm looking to get into the moves as they're happening. Whereas with some of our other strategies, let's say you're trading like even something as small as a 5-minute chart, which a lot of people consider to be very, very short term. With the 5-minute chart, you're still giving the market opportunity to digest the information, right? So let's say, for example, you're trading pullbacks within a trend. A pullback, to get to a particular trading opportunity, it could be a number of hours before you get presented the opportunity, right? Because the market will rally or fall off a cliff. It will show a great deal of momentum. Then you've got to wait for the pullback. After the pullback, you get in, and that could be a number of hours. However, with this strategy here, it's not quite the same. We're talking minutes. So once the market starts moving, we're looking to get into the move during that particular momentum move. So we're not waiting for the momentum move to take place, then for some price acceptance, and then the next momentum move. We're looking to get into the momentum moves as they are taking place. Does everybody follow that? Do you see the distinction there between the two? Yeah? Pen on fire is good. Anybody else? Okay, good. So a few of you are getting that. Wonderful. So as I said, the market condition is very, very important. Now before we get into the rules themselves, we should probably talk it. That's exactly what I was about to talk about, Georg. The time frame. What chart are you looking at here? Probably looks a little bit different to some of your charts, right? Would you imagine? None of them really look as clean and tidy as this. The reason is that this is not a time-based chart. Okay, this is what's known as it's a range bar, a range chart. This is on the euro dollar, and this is a 3 range. Okay, that's very, very short term, a 3 range chart. Alright, so we're not messing about here. Usually, for our day trading, we would trade like an 8 range. That gives us some time. But when I'm looking to trade volatility in the market, I drop down to like a 2 or 3 range and try and exploit it that way. So this is a 3 range chart. Now, who here has heard of range charts before or seen range charts before? This is Ninja Trader. It's similar to Renko, but it's not quite the same. Bullish pips, K-Churn. I don't trade Renko charts myself, but I believe with Renko charts the price has to move more for a particular brick to be created, whereas with range charts you're just literally looking at the price movement. Okay, so there's a subtle difference there between the two, but they are similar in nature all the same. Okay, so range charts ultimately are they're not time-based charts, they're price-based charts. Alright, so every candle on this particular chart you will see is the same distance from high to low. So we've got 3 pips, as you can see up here, so 3 pip range chart. So from the high to the low of every single candle, it is 3 pips, which is very, very short term. Okay? So what are we looking at for this system? Well, the setup that I've got here, I've got a number of moving averages. Alright, so I've got the 20, I've got the 60, and I've got the 100 moving average. Okay guys, so note that down. And they're exponential moving averages. Alright, so we're talking about the 20, the 60, and the 100 exponential moving averages. These are kind of like my moving averages of choice. Now, how do we use the moving averages? Well, they're used in 2 ways. First of all, they're used to highlight to us when a trend is in place and when we can look to get involved in the markets. So when the moving averages are all kind of crisscross like this, they don't quite know where they're going, they look untidy, we don't want to be in the market. We don't want to be trading that, right? It's as simple as that. When the moving averages are aligned, so for a sell opportunity, the 20 is below the 60 is below the 100, we're allowed to look for sell opportunities in the market. Okay, so when they're aligned like that, we're allowed to look for sell opportunities. When they're aligned 20 above the 60, 60 above the 100, we're allowed to look for buying opportunities in the market. Makes sense so far? Okay, the other way that we use them as our strike zones. Okay. Now, what I mean by strike zone is ultimately you'll see that this opportunity here, it would have made you money. However, this is not an opportunity that we would have taken because the price had not pulled back into the moving averages. Okay, so between the moving averages, once the price touches the moving average, we call that sort of like our strike zone. So that's where we're looking to enter the markets. If the price doesn't get back to that area, and it doesn't start to play with the moving averages, we're not really interested. Now, yes, that will mean you leave some on the table. So this one here, you would have left that. You wouldn't have made any money there. Nothing you can do about that. And it will mean that you do get into some opportunities which lose you money. But that's trading. Okay, there's absolutely nothing we can do about that. But what it does in the long run, okay, if you're looking for longevity in your trading, it will keep you out of more negative trades than it will keep you out of positive trades. Okay? What that allows you to do is, yes, we're looking to get involved in the volatility, but we're not just trying to jump in willy-nilly here and there. We're looking to jump in once we feel like we have an edge. All right? Moving averages are the average price of the last X amount of bars. Alright, so if we're to say that the price is in a downtrend, we're looking to sell. And we wait for, so let's take this opportunity here. We wait for price to get back to the last 100. Okay, so we're between the 20 and the 100. This one here is touching the 100. What that's actually telling us, if we believe that we're in a downtrend, the market is going to sell off, we're saying that the price is now at the average price for the last 100 bars, for the last 100 candles. So what that actually means is that if the price is going to continue, this is probably a good place for the market to start to go short. Now, I'm not saying that the market goes short because it's hit the moving average. That's absolutely ridiculous. I'm not saying that at all. All I'm saying is this indicates to us that price has had enough of a pullback now. It's gone through enough of a price acceptance phase for us to look at getting back into the markets in the direction of the trend. Does that make sense to you guys? Do you guys follow that? Okay. So we've got our charts set up. We've got the moving averages. We understand how we make them. So how do we enter? What is it that we're looking for? Well, first of all, we're looking for momentum in the market. So we're looking for the moving averages to be pulled apart, and we're looking for price to be pulling up back nicely. We like nice price action. Okay, so if you get price action like this here, I don't really know what to do with that. Yes, there's an entry, but would I have taken it? Very, very doubtful. Because it's kind of everywhere. I prefer pullbacks like this, a very nice smooth pullback. The reason I like a nice pullback like that is that when the opposite side, so the dominant force, get back involved in the markets, it's a lot easier to see. Okay, so you can see that the sellers, that this is all being sold off, and then suddenly, in fact, let me zoom in a bit so you can see the bars easier. Okay, then suddenly the bulls get involved. Okay, and that's something to take notice of, because what we're saying there is that, okay, if the bulls are involved here, if the dominant force are the buyers, what this must be is profit taking. So as soon as profit taking finishes, dissipates, then the bulls start to get back involved and they start to buy back the market. If they could push the market up here, like they did, and they're getting back involved here, one would imagine they can at least push it back up to the highs there, if not beyond. Okay, and that's the premise of our trading. That's what we're going on. Alright, so like here, when the market sells off and it pulls back to the moving averages, it's very clear when the sellers get involved, because all of this has pretty much been buyers all the way there. Then the sellers get involved, you've got two nice big bars to the downside. No looking back. You want to be in there, look at what happens. You get a nice pullback here, look at that pullback, very, very nice. The sellers get involved, and you want to be involved in that there. You want to be getting short there. Okay, unfortunately this one doesn't come back to our strike zone, so we can't get involved. This one does, we get stopped out. Then we can get involved in this one here. That makes you money, although to be honest I didn't get involved in that one there. It looks like there was too much going against it. But anyway, this one here, again, nice short, nice shorting opportunity, and you can see they're just all over the charts there. Okay, so it's really, really very easy to see that. Nice momentum, shorting opportunity, shorting opportunity, shorting opportunity. But the key here is the pullback to any MA, yes. Just pull back within that zone, Gil. The key here is to look at the price action. You don't want to be getting involved when the markets are kind of just, they don't have a clue what they're doing. You don't want to be getting involved in that. That doesn't make any sense for anyone. That's going to cost you money in the long run. You want to be getting involved when you can see where the markets are going, when you can feel the flow of the markets, if you like. Okay? So does everybody have that? So the entry criteria that we're looking for our trades, the entry criteria is a nice pullback followed by two consecutive candles back in the direction of the trend. Okay, two consecutive candles in the direction of the dominant trend. That's your entry. What if you add fib levels from support and resistance? Yes, I mean that just goes to strengthen it. If you can add fib levels and support and resistance, that makes it that much better. Definitely. What are the characteristics of a confused market? Okay, you see this market here. This looks really pretty, right? The market, when the sellers are involved, it's just going down, 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 little pullback, down, down, down. Okay, so we can see there that there's one force that's completely dominant. However, when you look at this here, who's in control? Who's in control over here? I couldn't tell you. If my life depended on it, I couldn't tell you. Exactly. No one's in control. And that's exactly the point. That's a confused market. This here, even though it's short-lived, you can see that clearly the buyers are in control there. They've gone from 116 up to 182 without barely looking back. So when it pulls back, you'd imagine if they've made all that money up there, they're going to have another go. And they're going to try and push the markets back up there. Okay? The moving averages as well help us to define whether the market is confused, because sometimes the price action is a little untidy. Okay? And you kind of need that confidence to say, no, you are in the direction of the trend. This is a good opportunity. Okay? And the moving averages do that for us as well. But ultimately, what I'm looking for is I'm looking for a clear direction in the markets, a nice pullback to the moving averages, and then the opportunity to take it, to go long or short or whatever. You know, this here, this is picture perfect. We don't get involved in that. It's not back to the moving average. You're in there. Long. Long again. Not back to the moving average. Long again, long again, long again, and long again. See, all of that there, you would have made money, made money, made money, made money, made some money, lost some. Okay? Now remember, you are scalping. So you need to put yourselves in the mindset of you're not looking to make 40, 50, 60, 70 pips on a trade. You're looking to get in there and maybe take 10 pips out of the market. Okay? You're looking to only take maybe 10 pips because your stop is behind the low of the candle. Now for each of these candles are 6 bars, your maximum stop in reality is going to be 7 or 8 pips. So you're looking for consistency, you're looking for a high strike rate. What about the breakout of 202? What, this guy here? We wouldn't have been involved in that Georg, because there's no direction, there's no way for me to know to be involved in this breakout here. The markets only trend 25% of the time. Yeah, perhaps the markets consolidate more than they trend. However, if you can learn to read the market condition, you can learn to get into the markets when it's trending. When it's consolidating, you stay away. This is why I said this isn't necessarily a strategy for a complete new person at trading, a rookie trader, so to speak. Because you have to understand a little bit about price action, you have to understand a little bit about market condition. But if you can do that, there's a lot of money to be made here. Okay? Just watching the markets, the volatility in the markets, waiting for the opportunity, and then taking that opportunity. Are there any questions so far? Would it work with regular? I guess you could use a similar sort of strategy on regular candles, yeah. I haven't tried it, but I would imagine so. No, we don't look for any specific signal on the bars. We do have a few backup indicators which we use, which are the stochastic and the CCI, for our other trading, which you could use here as well. But no, this is kind of just the momentum, so you're just getting into the markets with momentum. Range bars isn't available directly on MT4, but you can get some plugins out there. We actually, our members, we provide a free plugin for our members, but yeah. Money management, all in, all out. Yes, Gil. We're not looking to trail stops or anything like that. You're in looking for a high strike rate, looking to take small, kind of 8, 10, 15, maybe 20 pip profits out of the market, jump back out, wait for the next opportunity, get back in again. Gabriel, yes, we use this on longer term trading. We trade the 8 range chart and we trade the 45 range chart, and we use a very, very similar strategy. The only difference is that we've got a few more confirmation indicators. Diana, this is a 3 range chart. This is one that we find works well. I've got members who trade like a 1. I've traded a 2 at points, but this is a 3. This is kind of like a happy medium. It keeps you out of a lot of the crap, but at the same time provides you enough opportunity out there to make some money. The risk reward is roughly around 1 to 1. Sometimes you can squeeze it for a bit more, but you've got to be happy with 1 to 1 here. Yes, 3 pips per bar. So if you account for spread, you're looking at probably about 8 pips for your stop in total. Yes, Gabriel, you've got to have a high accuracy. So if you can be somewhere around 70% and above, you're good to go. Can you trade it on the cross of the moving average? I haven't tried that. Maybe. So should we recap the rules again, and then we can open it up for complete questions? Yeah? Okay. So the chart of choice is a range chart. We're using a 3 range chart. Okay? The pairs that you can trade on this, okay, have to be pairs with a very low spread. I'm talking about 1 pip or below. Anything above that, and your trading costs are a too high percentage of your overall profit potential, so it doesn't make any sense. Okay, so when you're scalping, the key is to keep your costs low, because you're going to be in and out many times. You know, you could be in and out 10 times in a day. And if you've got more than a 1 pip spread, you know, you're paying that to your broker. So if you imagine it like this, you've got like a 2-3 pip spread. You try and trade like, let's say, the pound yen or something, and you're in 10 times a day. You've got to make 30 pips just to pay your broker. All right, so the spread must be very low. We're trading a 3 range chart. We've got 3 moving averages. Exponential moving averages, the 20, the 60, and the 100 exponential moving average. Okay? If the moving averages are lined up, that's your permission to look for a trade. You're looking for momentum in the market. Once we get momentum in the market, you're looking for a pullback to the moving averages, to our strike zone. Okay, these are our strike zones here. When the market gets back to our strike zone, then we can look for the opportunity to take the trade in the direction of the trend. The entry signal are 2 consecutive bars in the direction of the dominant trend. So over here we're looking for 2 consecutive bullish bars. We get that. Once you get that, you enter on the open of the very next candle. So the close of this candle, open of the very next candle, you're in. You have your stop below the swing low. I usually give it like a pip or so below the swing low. But once you're in there, your exit, you're looking to see how price reacts when it gets to the highs, and if it starts to turn around at the highs, you come out. If it doesn't, you try and squeeze it for more. Ideally, you're looking for around 8, 9, 10 pips on each trade. Okay, and then once you've got all of that done, it's really about assessing the market condition. You're looking for the right market condition. Once you have that, then you can look to take the trade. So you're not looking to trade in the middle of consolidation. So if we trade in the middle of this crap here, it doesn't make any sense. Right? We want to trade when the market is moving, when it's showing us direction. Right? Like there, like here, not there, here. Make sense to you guys? Okay. Did I perform any back testing on this strategy? Not on the 3 range, Christoph. I trade this live. But I've done plenty of back testing on the 8 and 40 and 45 range. But this particular 3 range chart, I haven't done a great deal. I trade this live, but the results live are very good, so I wouldn't worry about that. Okay, Diana, you enter on, so let's say for example we're looking for long opportunities right here. You would enter when the price gets back to the moving averages, alright, and then 2, when you've got 2 consecutive bullish bars. So this would be 1, this would be 2, so 2 bullish bars in a row. Once you get that, you open on the open of the very next candle, okay? The profit target, you're looking for around 1 to 1, so really you're looking to extract 10 pips out of the market. However, you have to be nimble, so if you're coming up to a big support or resistance point and it starts to mess around, then you want to get out of it, okay? Excellent. Interesting alternative to day trading. Indeed it is. It's a nice system. For the 45, for example, will last longer for the EMAs to cross. Yes, of course it will. Would you use this for string trades? If so, yes, Pan on Fire. We use this, it's one of our main strategies actually. We use this for swing trades on the 45 range chart, and it's very, very similar. The only difference is that we use the stochastics in the CCI for further confirmation to enter and to filter out negative trades. The best time of day for this strategy generally is during the UK Open and then the afternoon, so somewhere between 1 and 4 p.m. UK time. When there's the most momentum in the markets. So are there any other questions? We'll now open up the floor to any questions you guys may have about the system, how to execute it, all of that kind of good stuff. We've got roughly about 15 minutes for Q&A. I haven't tried it on gold and oil bullish pips, so unfortunately I couldn't tell you. I'm not getting if there are too many bars on the left of the entry bar. Yeah, kind of. I see what you're saying. Yeah, you like the pullback and then you're trying to get in after the pullback. I've done a few of these for swing trades on FX Street already. I think there should be some recordings out there, but we can do something later on for swing trades. That's not a problem. Unfortunately, I can't disclose all of our rules because that wouldn't be fair to our members. But I can give you the basics of it, if that makes any sense. So point you in the right direction at least. Diana, any of the MAs, literally. It really doesn't matter which. The minimum stop loss here, you're looking for, I mean, you still need to give it maybe 8 pips or so. This is almost all, yeah, Gabriel, this one here, I know that, I don't know who's a new trader here or not, but I know for a lot of new traders that they're looking for like, you know, a very rigid system, almost like a set and forget. Unfortunately, real trading, when you're talking about scalping and doing stuff like that, that doesn't exist. It's not a reality. This does come down to a lot of practice, a lot of feel for the market, a bit of discretion. As I said, I know a lot of you don't want to hear that, but I'm just being realistic with you. I don't want to kind of lead you down the road of saying, yeah, you can do this, no problem. You just set and forget and it will all work for itself. Unfortunately, this system is not about that. Trading with market orders, Jano. Sorry, 1 second, guys. I'm just looking. We may have a live trade whilst we're online here. So log in to place a trade. Okay, guys. We can probably see this in action here. It looks like we're about to go long. Do not follow me on this, okay? Do not follow me. I'm not asking you to do that, but I'm just showing you I'm willing to put my money on the line for this system. Or not, if it doesn't trigger. The other thing you need to remember about scalping, right, is that ultimately you can be taking many losses in a day. So, let's say for example, you're usually willing to take like a 1%, a 1% loss on a trade. Because you can be taking many losses in a day, you might want to dial that back to something like 1/4%. And look for a daily loss limit and a daily profit limit rather than 1 or 2. Average trade duration could be a number of seconds, then it could be a couple of minutes. You're rarely in it for more than 10 or 15 minutes. Okay, Chan, the benefits of a non-time-based chart, a price-based chart, is it's a lot cleaner. So when you've got a time-based chart, you get lots of candles printed for no reason other than, 5 minutes has been exceeded or 15 minutes has been exceeded, etc., etc. Whereas with a price-based chart, it is purely based on price. So a candle is printed when the price range has been exceeded. So it tends to be a little bit more, a little bit cleaner, so to speak. So any other questions at all? We can sit and watch this one play out. Here we go. Favorite pair for this? Euro dollar and the dollar yen. Because they've got lower spreads, both of them. I get spreads of below 1 pip, so roughly kind of half a pip, which is nice. And they tend to move nicely. And you don't need that many pairs. When you're doing this kind of trading, you literally only need 1 or 2. If you're paying attention to more, then you're going to be struggling. Am I a broker? I'm not a broker, Ollie. No, sorry. No, don't use trend lines as much, to be honest with you. Not on this chart. This one's very much about being in the moment. Can I talk a bit more about our services? Yeah. As I said, we run a company called Traders Corner. Ultimately, it's an educational website. We've got 2 primary products that we offer, which are the video course, which is a very, very intense course, and then we also do an online bootcamp. The video course is kind of more targeted towards traders who want to get good groundings in the market, a good understanding of things. It also includes all of our systems, whereas the bootcamp is assuming a bit more prior knowledge and it only focuses on the systems. Does that make sense? So the video course gives you everything, but the bootcamp only literally kind of focuses on the systems. We also do market updates every week. So my brother does a very, very in-depth report, PDF report on all of the major pairs, which sets you up for the week to come, which is particularly good for those of you who are swing trading with full-time jobs and things like that. And we also do roundups, so video roundups on the weekend. And then every week we have a webinar as well, an educational webinar, much like this one, where ultimately the aim is to get all of our members to a point where they don't need us anymore, The costs. The costs for the boot camp, I believe it's about £500, £499, and the video course is £399. In pounds, because we live in pounds as well, so. So $499 for the boot camp, $399 for the video course, and I've just missed my entry. Son of a. Hold on. Oh, it's coming back a bit. Nice. Give me a second, guys. Yeah, there was an entry. I thought I'd missed it, but it's given me a second opportunity, so I'm in. So how many of you guys are trading red MASD entry? No, just the fact that we've got 2 consecutive bullish bars in a row. Okay, Chen. So how many of you guys are actually trading live? Yeah, we only buy on the retraces. That actually increases the accuracy, I believe. So you're just starting out your trading, excellent. Swing trading is good. There's absolutely nothing wrong with that. You know, and if you've got a full-time job, again, there's nothing wrong with that. I know a lot of people say, you know, we want to trade for a living and I want to do that, but you've got to ask yourself, why is it that you want to trade for a living? What is it about trading that you believe you're going to get from trading for a living? And make sure that it all makes sense, you know, because there's nothing wrong with using trading to supplement your current income. So, let's see what this is going to do. Do you guys enjoy trading? Because that's quite important, to be honest with you. You have to enjoy the process. If you don't enjoy it, there's really no point to it. It distracts from work. Nice. You'd like to learn? Well, drop me an email. My email is... I'll write my email in here. Drop me an email and we'll talk about it. See what we can do for you. Time consuming, time spent in front of the screen. Yes, it is. It is. But, you know, if you start to trade longer term, then that doesn't have to be the case. You know, we do a combination of both. So I'm in this trade right now. But equally, I've taken a longer term pound trade this morning and I've been in an Aussie trade for what seems like a friggin' eternity. Yeah. Actually, it's only been a few days, but there you go. If you practice all the days and you can learn from your mistakes, then it shouldn't take too long. But to be honest with you, it's very much a how long's a piece of string type question, because for everybody it's going to be different. There are going to be people that pick this up a lot quicker than others. Then equally there'll be people that don't pick it up as quickly. But, you know, you can get it. We have a lady, one of our members, and I'll be honest here, we've got a lady, how do I put this? She struggled a lot in the beginning, a lot. And to be fair, we did spend more time with her than we have done with others. We had a couple of conversations over the phone with her, all of that kind of good stuff. But she stuck at it. And, you know, credit to her, she's doing very well now. So it took her a good kind of, I think she's with us for maybe 18 months, 2 years. And all she did was lose money. That's literally all she did, day after day after day. And it was almost criminal. But we put in a lot of extra effort with her. And we got her to a point where, you know, she's not setting the world alight or anything like that. But she's able to make consistent profits from the market. So, yes. So you can get there in the end. Everybody can get there in the end if they're willing to put in the time and the effort. Who do I get such low spreads from? FXCM provide us very low spreads, but you've got to have what's known as an active trader account with them to get that. And I think you need, there's a minimum, I think it's about £50,000 or $50,000 you need an account to be able to get those sorts of spreads with them. But I'm sure there are other brokers out there that will do low spreads and will be just as competitive. You'd imagine so, wouldn't you, Manoj? That if you lose, you just reverse it and you'll be profitable. It's not quite, it doesn't quite work like that, because you're not profitable because the system doesn't work. You're not profitable because you're ensuring that you're not profitable, because of you. Okay? Sounds harsh, but a lot of the time that's it. So even if you reverse the system, you just make the mistakes the opposite way around. You can't open an FXCM account in Singapore. Really? I'm half, by the way, Singaporean. My father's from there. I do love Singapore. I miss it. Yes. There you go, Georg. One pick from Admiral Markets. Yeah, I spent a little bit of time out there a few years ago. I mean, obviously throughout my life I've been back and forth for summers and things like that, but I lived out there for about a year. Do you know Dover Rise, around there, near Holland Village? We lived in a very, very nice condo called, what's it called? Heritage View? Beautiful place. Is it recorded? I believe so. I believe it will be recorded. Are they safe with regards to security of funds? You know what? If you asked me this question a couple of years ago, I would have said yes. However, I had a very unfortunate incident with a company called World Spreads and lost basically into the six figures with them. So it was a very, very painful process. So I'm a lot more cautious now. The bigger ones, yeah, I think you'd be safe with them. But what I would recommend and what I do now is I tend not to keep any more than £50,000 in any one particular institution at a time, because £50,000 is the compensation scheme. In the UK, you've got the Financial Services Compensation Scheme, and they cover you up to £50,000. So anything over and above that, good luck. But up until that point, you're kind of covered. So now I kind of split my money about into different accounts, and I won't have more than 50 grand in any one of them. But that's just me. Exactly, Georg. So, are there any other questions at all? Thank you very much, Georg. Appreciated. Guys, if you liked anything that you saw today, or you want to find out more about us, please feel free to hop on across to our website, which is www.traderscorner. I'm typing it in the box here anyway for you guys. -online.com. Join our mailing list and stuff. You'll get the weekly analysis that way. Yeah, and thank you very much for watching. Oh, a couple of questions before I go. Is the USD the best pair for scalping? I personally think so because of spread. I was told by a UK broker recently that if you're paying very small spreads, then the broker will be trading against you. I think, to be honest with you, Manuel, that's a load of, excuse my language, that's crap. It's a very nice excuse when you're losing money, but in reality, it's a big market. The brokers can't really trade against you. For the sorts of positions that you'd be taking, I doubt it. I think it's too big to become a robots market. I'm not saying you can't have robots functioning in this market, but it's huge. So, yeah. So thank you very much for watching, everybody. I look forward to speaking to you on our next webinar. We're actually going to do some live trading on the next one in 2 weeks' time, so on the 19th. And we'll do some live trading. We'll look at this strategy, and maybe we'll trade this one live as well. So, yeah. Thank you very much, and I look forward to speaking to you all soon. Have a great day in the markets. Enjoy the non-farm payrolls later, and I'll see you in 2 weeks' time. Okay? Thank you very much, FX Street, for having me. And, yeah, I will speak to you all soon. Take care now, and have a good day.